Okay, let's go ahead and book August. For August, we have a special treat, right? We're going to demonstrate the power of journal entries, and we will demonstrate how you can book transactions in a catch-up mode and like really crunch mode. Well, we'll show that in September, the real crunch mode, and then in October we'll show how to book off statement, but this is kind of the progressive crunch mode. So this is one of those moments when you really need to get it done and you're going to use journal entries. We don't need to explain it in our field here. So debits and credits are right here. So follow along and let's get rolling. Okay, first we have, again, remember when you book in post factum, you're going to book by the date that the invoice is paid. All right. Okay, so what do we have here? Well, it's paid with a credit card, right? We know this much. So let's go ahead and find our credit card. Here it is. What's happening with the credit card? Well, the liability is going up, and liabilities go up when they're credited, right? So here we are. All right, we can put in the description, we can put our invoice number. What else is happening? Well, our expenses, right, on supplies are going up as well. So that's our food purchase supplies, right? So here they are. Expenses go up when debited, all right? So what we have is, again, we have debits for account 6200 and we have credits for account 21100. 21100 is a liability, it goes up when credited, right? And 6200 is an expense, and expenses go up when debited. All right, next one, very much similar. So let's go ahead and follow along. Again, we're going to use this date right here. Invoice. All right. So this one, again, it's paid with a credit card, right? And it's a liability, and liability goes up, and therefore it has to be credited for it to go up. And what else is happening? Well, again, our supplies, right? In this case, it's our food containers, right? That's our restaurant supplies. They're going up. That's expense going up, and it has to be debited, right? So here we are. Date is correct. Invoice is correct. Okay, saving here. Next one, we have cleaning supplies. Again, let's make sure we use the correct date, 8/20. We can go ahead and adjust it right here. In this case, we're using a check. So again, in the journal entry number, we're going to use check number. So it's easier for us when we reconcile. So what is happening in this case? Well, our bank account will be reduced. Bank account is an asset. Assets are reduced when credited. All right, right here we can put our invoice number for reference. Okay, and our cleaning supplies, that expense is going up, and expenses go up when debited, right? Therefore, here it is. We're good to go. We're going to book this one. All right, now we have drink supplies. All right, and this one is paid with a credit card. Again, make sure we use the correct date. All right. What's happening here? Again, our liability, right, our credit card is going up. And liabilities go up when credited. What else is happening? Well, our drink purchases, our supplies for operating our food truck are going up, and expenses, it's an expense account, expenses go up when debited. Okay, we have one more check. Again, make sure you use the date it's paid, not the invoice date, right? Because we're booking post factum. Again, here we're going to enter the check number. All right, again, expense, I mean, the bank account is an asset. Assets are reduced through credits. Okay, what's happening here? Well, our utilities expenses, right? On utilities are going up and expenses go up when debited, right? So here it is. Date is correct. We're good to go. All right, and then we have one for multiple expense accounts. Again, general journal entries are wonderful. They allow us to book whatever we want because it gives us access to all the debits and credits, right? Okay, 1024. All right, so first thing first, right? When we have complex, what do we want to get out of the way is the bank account, right? That one is simple. All right, bank account will be reduced, the balance will be reduced, therefore it has to be credited. All right, and now we can begin to offset this credit with debits to corresponding expense accounts. Okay, so first we have lease, right? So our rent expense, that one at 1,000. What else do we have? We have insurance. All right, insurance expense at 150. We have dues and subscriptions for our registration. All right, 50. Okay, maintenance, 85. And finally, we have our advertising and promotion, right? Because remember, for that artwork, we're paying overtime. So here it is. Debits and credits are in balance, right? Even though we have multiple of them, doesn't matter, right? All of these expense accounts are going up, and therefore they're debited, and we're paying with a check, and therefore the balance in our bank account will be reduced. Bank account is an asset, therefore it has to be credited. So here it is. All right, so we're done with invoices. Now we're going to move forward with credit card receipts, and we're going to stay in the journal entry. Here it is. All right, so let's continue. Again, make sure you watch the date. Okay, all of these are going against the credit card, right? So we know the liability will be going up, so we can get that one out of the way, right? To know what to balance. Well, now we just need a debit. Well, that's fuel expense, right? Expense is going up, debited. Liability goes up, credited. Again, see, debits and credits are in balance. Good to go. One just like that, but again, practice makes it perfect. All right, again, let's get our liability out of the way, right? We know it's going up because the fuel ain't free, right? So we have to get the funds somewhere, and in this case, when we use credit card, we borrow it. Nevertheless, even though we borrowed the funds to purchase the fuel, our expenses are going up, right? So here they are debited, liability is credited. Our cell phone expense, right? Okay. Watch the date when retro, always important because you might be a little bit off. Alright. Let's put it here again. One thing we know for sure, liability, our credit card is going up because we're paying it with our credit card. What else is? Well, telephone expense is going up as well. Here it is, right? Simple as that. Our liability is going up, credited. Our expense is going up, debited. All right. Next one, we have a return, right? But we can still book it using our journal entries interface because, again, it's all powerful. It can do anything you want. So here it is. Let's just get that done. So what's happening here? Well, we know that once that book is returned, and in this case, we're returning the management book, right? We purchased it, then we realized probably we're not managing any employees right now. We can wait with that one. We'll stick to bookkeeping and accounting and sort of, operating our food truck. So anyway, we're returning this management book. Once it is returned, our liability will be reduced, right? Because the vendor will refund our credit card company. So let's reflect that, right? Liabilities are reduced when they're debited. So here it is, right? It's being returned. What else is happening? Well, our expenses are reduced as well because we're returning an item that thought to be, again, our training material expense, but now we're not using it, so expenses are reduced when they're credited, right? So liability is reduced because once that book is returned, we will get a refund in our credit card account and liability will be reduced and therefore it is debited. But also we return that book and therefore our expenses on training material are reduced and they have to be credited. All right. What else do we have? Well, we have a payment, right? We're paying down our credit card balance and it's very much similar to the return, right? So let's make sure we capture that. Okay, so once again, liability is going down, right? We're making a payment from our bank account to our credit card. And liability, as we just demonstrated, is reduced when we debit it. So here it is. All right. What else is happening? Well, the money is coming from somewhere, right? It can't come from thin air, and therefore it's coming out in this case from our bank account. We got to have the offsetting credit entry, and we know that bank account is an asset, and assets are reduced when credited. Makes sense, right? The money is leaving our bank account, 11,100, right? And it is used to reduce the liability, 21,100. Debits and credits are in balance, right? Everything is good, saving you. And we done booking receipts for the month of August.